Hey, Kevin, how are you?
Hey, I'm doing good, Alan. How are you?
Oh, Alan's not here yet. I guess we
Oh,
look the same. He does look like a dummy. I know that. Kevin, how much do I need to retire?
hey, we're going to talk about that. We've got some good tools and good information to get you ready to go.
All right, but my question is, how much should I budget for my own retirement costs? I do like to travel.
Do you? Well, we haven't had a chance to find out all about your spending goals, but you know what? We can maybe put together a balance sheet for you, talk through your goals, see what things you want to accomplish, and find a way to help answer that.
I want to save $1 million so I can go down to the Caribbean and set up a puppet government.
You're going to save a million? Okay. How many years you got to do that?
Well, Alan pays me $1 an hour, so however long it takes to come up with $1 million.
Well, we're going to have
I don't
to
know
we're
what
going to have to come up.
taxes I'm not a single person. I'm not a married person, so I can't figure out my tax rate either. Can you help me with that?
You got a pretty complicated situation there, but I'm sure we can get you there.
All right, because sometimes I read these rules and my head spins. All right, here he comes. Don't tell him I was here. Okay. Oh, welcome to this presentation entitled Spreadsheeting and Illustrating Retirement Planning. If you came in through CPA Academy, you will get credit as long as you answer the 4 or at least 3 of the polling questions. If you did not come in through CPA Academy, you can get continuing education credit if you're a Florida lawyer. Just let us know by email and we will send that to you. My email address is shown at the bottom of left-hand side here. If you have questions, you can click on the inverted pyramid in the question panel and we will see the question, and if it's easy enough, we will answer it. If it's difficult, then Kevin will answer it. Kevin Miller, by way of disclosure, is my own personal financial advisor and a very, very good one. He is a CPA, a CFP, and a CPWA. Kevin, what is a CPWA?
That is a certified private wealth advisor designation. So it's a kind of an add-on to the CFP geared towards high net worth families.
Perfect. So when I went to work on our Nest calculator for retirement planning, I went to Kevin for some input and he was very interested in it. So we've been working together on that calculator. And what I wanted him to do today, because most of our attendees are CPAs, was to give the CPAs who are not financial advisor experts, to give estate planning lawyers who are not financial advisor experts ammunition so that we can have meaningful discussions with our clients to get them to a financial advisor. And of course, the reason for that in my realm is that clients, no matter how successful they are, usually don't really have a feel for how much they need to spend and how much they need to save. And then I have a lot of wealthy clients who spend at a very healthy rate to where their children will never be able to have a standard of living like the one that they enjoy. So for your medium-sized and small clients, they need this planning. For your wealthiest clients, they need to understand it as well so that they can help the people they care for be financially independent. Now, before we get started, in case you want to play with the software during the presentation, I'm going to open it up here, reload the page. This is the Estate View software. It's available to you free of charge for at least a couple of months. You go to, in your browser, estateview.link, estateview.link, and then you use the name test at test.com, TEST at TEST.com, all small case. Then your password is test, T-E-S-T, and then you can go to the Nest Retirement Calculator. And I'll show you briefly how it works, because if you're a novice in this area, you might want to at least know about this. We have a Swift plan mode, which it's automatically in when you open it up. And here I have, if you look at the inputs on the left, a 40-year-old married to a 38-year-old, hopes to live to age 85. The 38-year-old hopes to live to 85, would like to retire at age 60, would like to have the equivalent of $175,000 a year to retire at age 60, expects to understand inflation, wishes to leave at least $1.5 million for the family members, and has a $750,000 house growing at 3.53%, $1 million of investments growing at 6.5%, and is saving, let's say, $55,000 a year, and will be able to increase the savings by 3% a year as he or she advances financially and in their profession. Investment costs 0.75% a year, taxes on the investments 1.5% of the total amount of investments, $200,000 in debt. So across the top now, what this tells me is in green, at retirement at age 60 in 40 years, they will need $7,854,000. And as of today, they are short. They are short by $98,000 a year of savings, or today they would need an extra $1,668,000 invested to make the goal, or they can work until 69 instead of 60, or the retirement income will only be $96,000 a year in today's dollars. Now, what I can do is click on duplicate. And when I click on duplicate, I now have a second scenario called Nest 2 there. And it's identical to Nest 1, but I can just change something. For example, what if spouse 2 is not working, but would be able to work? So spouse 2 could increase savings by a certain amount. So I can go to where the $30,000 a year is that they're saving, or the $55,000 a year that they're saving now. If spouse 2 could net $30,000 a year working part-time, I can move this to $85,000. I can type in 85K, 85K return. And now, where are they? Well, now they're still short $63,000 a year, even after that. So we could go ahead and retire at age 64. We're almost there. Age 65, we're there. So now I can highlight in yellow or other colors what that result difference was and what the savings difference is right there and there, and the year of retirement. So that generally explains how the calculator works. The other thing I can do is I can go into more detail. So I can come out of the Swift mode, and now you're seeing more things across the top in white, and I have more inputs. These blue ribbon on the left shows me that I could change the amount to be received at a certain age. Let's say that they want to get $175,000 a year, but they think that at age 78 they'll be slowing down to $100,000 a year. That makes it easier to meet the goal. And maybe after they've retired, the tax rate will be lower as they earn less money. And maybe they'll have an inheritance. Maybe they'll get Social Security. Maybe, though, they have to pay for a college or for a wedding. And what you see across the bottom is a handy dandy spreadsheet which shows them and shows the planner what happens because of each of these things. You know, for every action, there's an equal and opposite spreadsheet column. You know, you want a vacation home? Great. How are you going to pay for it? So that you can show every other line on this spreadsheet, or every third line, or every fourth line, so that the spreadsheet can fit. And then you can export this to an Excel document. So then you open the Excel document, and then you have their remnants of a financial plan showing them, you know, if you just went to Saks a little bit less and you save $5,000 a month, here's how much more you'll have, or how much sooner you can retire. The other thing it does is it tells you how short you are. I'm short, I'm 5'7". But by that I mean it tells you how much life insurance you need if you're going to die in any particular year. So they need $5.8 million of life insurance if he dies this year to make this goal. And he needs at least $4 million through year 6. So now I can click on life insurance estimator, and Mary is age 38. Do we want to put coverage on her? Here's what it costs per million. And Bob is 40. Do we want to put coverage on him? Here's what it costs per million. Here's what term policies are available, and what a lifetime universal policy would cost. So finally, I go to timelines and charts, and this shows me with these two different scenarios what their net worth will be. I like Nest 2 better than Nest 1. It's a nicer net worth. Shows a timeline of Nest 1, what happens during the years when you start going negative versus positive, and your probability of surviving each year. So Kevin, I'm going to turn this over to you now. How do I give Kevin control of the slides?
Sure, I can go ahead and switch that over to him.
While we're doing that, let's do polling question number 1. You have to answer at least 3 of the 4 polling questions. We've made them very, very difficult. The first one, do you A, practice accounting and advise on investments? B, you only practice accounting, you do not advise on investments? C, you are an investment advisor, you do not practice accounting? Or D, none of the above? Anthony, what percentage do we have having answered? 85%. Okay, who answered A? How much A and how much B? 50A, 52B. Okay, so 52% of you do not give investment advice, and did you say 12% give investment advice? A 15, B 52. Okay, what's C? 3. So 3% only advise on investments. Okay, so how do I hand control over to Kevin, or does he have it?
Yep, I just passed it over. Kevin, you should be able to do that.
You got the slides, Kevin.
All right, give me just a second to get that kicked off. I may need a little bit of guidance here because the slide deck is not noted here. Joey, would you be able to direct me on how to get the slide deck showing?
Are you able to share your screen? There should be a share screen button right on the control panel there.
I got a show screen.
There you go.
There it is.
But I don't have the slide deck available to me.
Okay.
All right, I'll move the slides.
Okay.
I'll move the slide.
All right, great. We can do the shared screen towards the end there. Do you want to take back the
Got it.
there, Alan?
Yeah. Okay, sorry for that technology glitch, everybody. Take it away, Kevin.
Awesome. So Alan did a great job of just showing us how Nest works and how we can use that as a tool to illustrate different scenarios in retirement. My hope is to spend maybe 10 or 15 minutes and just talk about kind of the softer side of how do we get to where we want to go, and what are some other tools that we can use to help us prepare for that conversation. So for us, all of our clients, one of the first things we do, and something that is a part of all of our agendas, is a review of the personal balance sheet. We find that without a comprehensive balance sheet, it's difficult to not only prepare retirement projections, but also to just understand clients' goals and see how we can optimize their overall situation. So I encourage everyone, even if you're not giving investment advice, to consider this as something that you expose your clients to, because it's a great, at a minimum, just a scorecard for them to pull out every other year or so and just see how they're doing. But it really allows you to entrench yourself in the relationships and add a lot of value to things outside of just maybe tax preparation. So when you think about, well, how would I start? Where would I begin? Really, the first thing to do is just ask for investment account statements. You know, most folks, that's going to be a very easy thing for them to gather, their quarterly investment statements. The other is to look at the tax return. You know, a lot of the information that you'll get from a balance sheet, if you have the account statements and the tax return, you'll understand pretty much everything that they own. You may not see all of their liabilities, but as far as their assets, that should really show up pretty well. And then lastly, just going through an interview with the client. So many of my meetings start, especially, you know, in the onset of a relationship, with a blank balance sheet, where we just simply go through and say, tell me about your financial situation. Tell me about your life insurance. What about your personal assets, the real estate you own? We don't do a lot of organizing personal belongings, but I always ask the question, is there anything that you own that you would insure? Things like jewelry, ATVs, jet skis, what are those things? And you'll see that as you go through this, if you really spend time on it, you're going to uncover the client's crisis plan. Because my take on it is, when I think of the use of Nest in any financial tool, we want to make sure first we've got the foundation set. You know, Nest has a great opportunity to use and discuss life insurance, but we also want to make sure that we've got property casualty, things like that taken care of, umbrella liability policies, a funded estate plan, adequate cash reserves, that we're not carrying unnecessary consumer debt. And that should all come forth in the balance sheet. Alan, if you don't mind, if we could go to our next slide. So this is a sample balance sheet that I use. In the upper left-hand corner, you're going to see where we've got the personal assets. Bottom left corner is where we have the insurance assets. Top right corner would be personal assets, and then bottom right will be liabilities. So a couple things that I want to share with you. I mentioned the elements of a foundational plan or a crisis plan. The things that I'm looking at would be, A, is there evidence that the client has an estate plan? And things that would help you understand that would be, do they have a trust? Are there brokerage accounts in the name of their trust? If you think about the tax return, you probably have copies of the property tax filings. Are those in the name of a trust? Or are they even coordinated? Perhaps trust isn't applicable, but do we have coordinated plan there? And that's going to show up on the balance sheet. You'll notice we've got a column there that talks about primary and contingent beneficiaries, making sure that we've taken a look at things like their IRAs, their 401ks, and that they have consistent beneficiary designations. Of course, reaching out to folks like Alan and finding out, hey, are these still appropriate? So we can help organize the estate plan with this tool. I find that 50% of clients don't have an estate plan, or they do and it's out of date. So this is a great tool to help a client prepare to go see a guy like Alan and say, hey, here's where I'm at. My advisor thinks I need to sit down and have my estate plan reviewed. And now this tool is already there and helps out that process. We'll talk more about life insurance, but this helps us just understand in general, how's the client situation relative to life insurance needs. So thinking about crisis planning again, estate plan. Second would be insurance matters. If we go to our third crisis piece, we're looking at the top right corner. If I'm evaluating this client situation, and we're going to use this balance sheet really as part of the case study towards the end, but I look here and I see they've only got $5,000 in cash reserves. So when I look at that, that's an immediate conversation related to, you know, how is your foundational plan if somebody loses a job, if they experience a disability, an untimely passing. So this gives us an opportunity to assess their crisis plan from a cash reserve standpoint. It also sometimes opens up opportunities to find ways to help clients. So a very common thing as we've gone through the past couple of years of market volatility is clients have been a little bit shy to add to long-term investments. So now when I go through the balance sheet, I find people that have $250,000 in cash reserves. And that opens up the question of A, are you getting the maximum yield that you should with money market rates at 5.25%? Or B, do we need to think about allocating dollars towards the long-term plan? And again, why this is important is when you think about having this tool available to you, and then you think about how you would apply it to a tool like Nest, those would be great things to be able to say to a client, hey, you've got $250,000 of idle cash. How does that change your financial plan if you were to say do a one-time addition of that cash into a long-term investment program? Same thing with the life insurance piece. So go through and gather those personal assets. The other would be, it's common that we have clients with second homes, maybe even third homes, and looking at how would maybe part of the plan is you're going to downsize your house. I'm from Kalamazoo, Michigan, so it's very common that our clients downsize their house and they move south. So what's the implication of that? Does that mean that we're going to be adding money to the portfolio, or does that mean we're going to be taking money from the portfolio? So again, just flushing out all of those things. And then on the debt reduction side, or the organization of the debt, making sure we have a good sense of those variables as it relates to their financial plan. Do they have any high interest credit card, consumer debt, home equity line of credits have snuck up on a lot of people because they didn't really understand the impact of a variable rate. When they were borrowing money to do a new home remodel, they borrowed 100 grand at 3%. Now all of a sudden they're surprised to see that at 8, 9, 10, 11%. So just kind of spending time there. Point being is with this tool, we're better prepared for the long-term plan. And I've observed with a lot of clients, especially new clients to me, they find that their advisors focus most on the investment strategy or the long-term financial plan, and they haven't bothered to take the time to really address the shorter-term things. So they're really putting the cart in front of the horse. So here we're able to really get a good sense as to where clients are. Alan, if you could for the next slide.
Sure.
Thank you. So again, if we think about, okay, we've gone through this process, we've looked at a personal balance sheet for today, maybe this will be a follow-up presentation, but we haven't talked about cash flow management. There's a lot of online tools that do that for you, data aggregators, things like the mint.coms that can help clients understand their cash flow. I find that sometimes it's just as simple as saying, okay, what are your W-2 take-home pays, multiplied by 12 months, and that helps us understand what's their current household income and their ability to what they're spending or what they could save. The other part is where are they going? So we know where they're at, where are they going? What are those short-term goals? What are the things that they need to be thinking about just in the next 3, 6, 12 months? New house, home repairs, new car, those kind of things. And then the long-term plan. What are they focused in on for? What does retirement look like? What does their estate plan look like? Are they leaving a legacy? What kind of things are they trying to do there? Or more advanced pieces like charitable goals, college savings, things like that. You learn a lot about people as you talk to them about their spending needs when you just learn and listen about their current situation. Folks that are taking, I'll use Michigan example, folks that are driving up north and spending a few days at a cabin in northern Michigan, that's a lot different than folks that are traveling the world. So we need to make sure we understand what are their current habits, because most people don't really want to take a step backwards when it comes to how they enjoy their current lifestyle. So just learning from them in the interview process. And then lastly, how do we get where we want to go? It's just an algebra equation in many ways. When you really look at what Nest does, Nest allows us to isolate variables like you would have in 8th grade algebra and figure out how do I solve for an unknown variable. And that's really the heart of the retirement projection. I always tell people, the beauty of retirement projections is it can create a lot of excitement. I've built projections in meetings where you see people go from thinking that they're way behind their goals to looking at their partners and smiling and saying, hey, this is great, this is awesome, we're where we need to be. And I've also seen a lot of people look at each other and have an oh no moment where they look at each other and say, wow, we got to make some changes. So there's that softer side of this of being prepared in advance and kind of knowing what to expect and gauging that, because sometimes we're creating excitement and sometimes we're unfortunately kind of crushing people's dreams. So we got to be conscious of what that looks like.
Kevin, I'm going to go, this is very good. I'm going to go to the second polling question. The second polling question is, are we going A, too slow, B, too fast, or C, I don't understand the question, or D, if you like, which can be just right. So A, too slow, B, too fast, C, I don't understand the question, or D, just right. How are we doing, Anthony? Okay, what percentage are saying too slow and what percentage are saying too fast?
35 too slow, 15 too fast, 50 don't understand.
Okay, 50% don't understand the question, so there's just no hope for half of you. But more of you are saying we're going too slow than too fast. So we can
Okay.
speed up. That's good to know.
Yep,
All right.
we'll do that.
Okay.
Awesome.
All right. Were we here?
Yes. So covering this slide quicker, what I always tell people when I look at their situation is there's a lot of known variables and we can isolate those quickly. What are your current resources? As far as future resources, I don't like to plan for a lot of unknown incomes because sometimes, people think that, hey, mom and dad got me covered, I'm going to inherit a couple $1,000,000, and that alters, their own financial plan. And with long-term care, medical expenses, greater longevity, that can be a real risk. So as far as understanding future resources, I encourage people to be conservative about that, but there are going to be some known things like real estate, sales of business, savings goals. The spending goals I talked about, you could do a cash flow statement. You could have the client provide some, W-2s. You can have clients provide pay stubs to kind of understand where their spending goals are. Return assumptions is a variable that we don't dig into. Maybe this will be part of a follow-up presentation, but the return assumptions are critical. And one of the things that makes me nervous about my industry is that folks may exaggerate return expectations as a means to make the scenarios look good, meaning like, you're a little bit behind. Well, what if we could get 9% instead of 7%? And that kind of resolves a lot of those problems on a spreadsheet. So we want to make sure that we're being very reasonable about those rates of return and make sure that they match what the client's actually doing. I've had a lot of clients that come in and they're assuming they're going to earn a 7% rate of return, but they're in low yielding cash-like investments. Now, granted, the past 9 months, that might not have been the case, but historically, they're not lining up their actual strategies with their potential outcome. So we want to make sure that we consider our reasonable rates of return when we're building those projections. Then, of course, we have things like life expectancy, tax assumptions, and inflation expectations that all have a meaningful impact on the projection. So we need to prepare for those variables. All right, next slide, please. Oh, we covered that one. So I find that there's two types of clients. There's the organized clients, the engineers, our CPA folks, if I generalize, that they know what they want to do. They've already given it consideration. They've had those conversations with their partners, and they know we want to spend $10,000 a month. And I always try to focus in on the behaviors for those folks. We know what we want to do, so now let's look at the behaviors. Things like savings goals and a disciplined investment strategy, rates of return, asset allocation, because those folks already kind of have a sense as to where they're going. They just need the input of, okay, if you want to do this, then here's the things that you have to do. The other group of folks come in and they're just on autopilot. They wake up every day, they go to work, they just save what they can. They don't really know what the outcome's going to be. And for those, we need to focus in on the results. So what we need to do is say, okay, here's what you're doing. And this is what you're likely to get if you just keep doing what you're doing. You're saving 100 grand a year on accident, kind of. Well, cool. You're probably going to be able to spend X amount of dollars and get them thinking about, if they continue that behavior, where are they headed? For me, both of those scenarios are very comfortable, and most of the projection software, especially Nest, will help clients understand that. But just kind of trying to isolate which client are you talking to is very helpful in making sure that you're tailoring that conversation.
And let me just mention, when you're in a meeting with a client, just say, do you know how much you need to retire and whether you're on track? And my gosh, they'll just stop right in their tracks. And very wealthy, very successful, especially professionals, those two questions, that's an attention getter. Try it out and see if I'm wrong. And then, enhance your relationship with them by talking candidly about the situation, and maybe candidly about how they got to be age 53 and wealthy and don't even know how to answer that question, because they deserve to know. They're able to understand a lot of this. So a lot of this is helping to teach them.
Absolutely. So when we start the conversation, we look at the different types of projections. One of the things that I wanted to share when we go through Nest is when Alan first presented Nest to me, what I loved about it is it was one of the most, if not the most, obvious ways of explaining this stuff. And I think that the way that it balances complexity, but also with simplicity, is a great tool for advisors. But there are things that we still want to be aware of and consider as it relates to some different types of tools that are out there and how different things may apply. So when we look at the projections, we're looking at what we call straight line rates of return. We're just assuming that the rates of return continue in the same pattern over time, and we know the markets don't behave that way. Now, trying to explain that to a client in a 5-minute conversation is not appropriate. They're not going to get enough out of that. So straight line returns for initial conversations are a great way to get the conversation started, because we're not going to educate clients in their first meeting of exactly what those implications are. So comprehensive financial projections would be ones that would include a Monte Carlo simulation, which is really just creating randomness within those investment returns. And that may help clients understand the impact of, yeah, I may get 7 or 8% a year, but that means that depends on when I get those 7 and 8%. So Monte Carlo can be an addition to a straightforward projection. The other thing is just understanding some tax assumptions. So when we get into the Nest, one of the things that you'll understand too is that someone that's got, and it's very obvious, but somebody that's got $1 million in a brokerage account versus $1 million in a Roth IRA or $1 million in a 401k, those are going to be 3 different outcomes if they were to all start distributing that money because of tax assumptions. So we don't spend a lot of time, especially in today's conversation, trying to differentiate between those two. So I want to acknowledge that there's some areas that we would want to spend and drill down further in future conversations. But for today, we're really just trying to get that highlight, kind of get the light bulb going for clients that maybe haven't had a plan done for them yet. All right, ready for the next slide? So for the case study, what I've just tried to do is illustrate a general interview, and I won't read the slide to you, but I'll just kind of highlight it. We're talking about a younger couple that's happy with their employment. They're in a position where they've really just enjoyed their lifestyle. They've kind of saved by accident. They don't really have a plan right now. When they retire is not critical. They enjoy the things that they're doing. So they're really trying to just understand, when I go to retire, will I be able to continue my current lifestyle? Or, you know what, when the kids are out of the house, if I paid off my debt, maybe I can live on less. So they present with one of those. I'll kind of put them in between the two variables. They kind of know where they're headed, but they haven't really put a lot of thought and effort into understanding the behaviors that they need there. They are nervous investors, so they've told us that they are willing to accept risk, but when we look at the balance sheet and we look at their account statements, that may not have been the case. So we're going to try to illustrate kind of the impact of rates of return on their scenarios as well. All right. So Alan, now might be a good time for me to try to do our shared screen version so that I can start our live demonstration of our case study.
Okay, how do we do that, Joey?
Sure, so I just switched that over to you, Kevin. You should be able to share your screen like you did last time.
Okay. So I need to make sure that the screen that I'm showing is the right one. Are you able to see Nest?
No,
I see the PowerPoint.
we see the case study.
Okay, perfect.
Now
You can see Nest. Okay, I've got 3 different monitors going.
Yeah. Before we start this, let's just do polling question number 3. Would you like to beta test the Estate View software? It is free. We'd love to have your input. A, no, but I have a beta fish. B, yes, but I don't have a beta fish. C, now I'm really confused. Or the best answer, yes. So if you say yes, if you do have a beta fish, then the answer is D, if you want to test it. If you don't have a beta fish and you want to test it, the answer is B. If the answer is no, but you have a beta fish, then the answer is A. Or if the answer is no, but you don't have a beta fish, then the best answer is probably C. Is that pretty clear, Joey?
I'm really
That's how you run. That's how
you
you run a webinar. That's how you run a webinar. How do we do, Anthony? 88% is A?
A is 28.
Okay, only 28% of you said no, but you have a beta fish. Well, that's a lot of beta fish.
That is.
Good. Okay, let's go back to the presentation, which probably won't be as good as this polling question.
Okay, so I can confirm I see Nest. So what we're going to do is go over a couple of different scenarios. So in this first case study, we're looking at someone that's age 45 with a life expectancy of 95 and retiring at age 62. They currently are spending about $20,000 a month, so $240,000 of desired retirement income. We're going to use a 3% inflation rate, and we're going to assume they've got about $1.5 million in investments. So we've applied a rate of return assumption of 8%. I wanted to highlight that variable as I kind of discussed in the interview questions that I would have shared with the clients, that we're going to assume that we're going to want to talk further about that because they've been pretty conservative investors, and we want to make sure that they have a reasonable expectation for their investment strategy. They're saving about $100,000 a year. They're paying an investment advisor 0.75% to manage the assets in total between the mutual fund expenses and the investment advisor, so a little less than 1%. And their investment expenses are about 1.25%. Excuse me, their tax expenses are about 1.25% of their total earnings. So when we look at that projection, we just follow our Nest one across age 45. What we can see is they've got about $1.4 million deficit in order to get there in total, meaning that they need $8 million, but their behavior is putting them at about $1.4 million short because they're only going to have about $6.8 million. Alan already kind of walked through this, but we'll just use these variables today. And I'm going to zoom in just a little bit. I may have to scroll around a little bit, but just make it a little easier to see. So we've got $1.4 million shortage. So they could either start saving more on an annual basis, they could work a little bit longer, or they could spend a little bit less. This goes back to trying to evaluate the client we're talking to. Is this a client that is like, okay, fine, I'll just work a little bit longer. I wanted to retire at 62, I'll just retire at 66. We now might be finding that flag in the ground that says, okay, this is the important variable. They might look at those numbers and say, wow, I don't want to work till I'm 66. I really need to get aggressive about my savings. Or maybe we're going to look at that and say, well, the truth is, if they were to just sell that second home and add $550,000 of equity into their plan, maybe they're really not that far off on their plan. So what I like to do when I'm building a projection is I like to have what I call their core scenario, their core plan. And that core plan is, frankly, the least amount of unknown variables and the most likely thing to happen. And if I can get a client bought into that, hey, let's just keep it simple. Here's the 5 or 6 things that are going to be the most critical of the plan. Then we can start testing the plan with other variables and bringing in what I just call the what ifs. So if we think about some of the what ifs,
It'll come right back.
Okay. So if we start thinking about some of the what ifs, let's go to a scenario 2. So for scenario 2, and this is in the slide deck, but it's not going to show up because I'm sharing my screen. But in the second, let's just say that we look at this and say, well, maybe we're going to just spend less money. Okay. So in this case, what we're going to do is we're going to say, instead of a goal of spending the $240,000, we're just going to spend the $180,000. What does that do to our plan? Now the client has the opportunity to look at things in maybe a more positive way. They could maybe save a little bit less. So maybe in this scenario, the client said, hey, you know what? We don't really need to spend that much money. In fact, maybe with what we can do is we can just plan to spend a little bit less in retirement and enjoy things a little bit more now. So they actually have a surplus in their savings goals. They could maybe retire a little bit early. They could maybe spend $216 instead of $240. So in this case, what we're kind of doing is isolating, all right, what are the desired retirement outcomes? We're gonna downward adjust those. Some other examples would be if we just duplicate that original scenario. So now I'm looking at scenario number 4. Hopefully that's showing up well. Let's talk a little bit about those investment expectations. Actually, what I'm going to do is, I take that back. I'm going to delete scenario 4. And I'm going to use scenario 2 as our test. So they've agreed now that they're going to spend less money. Okay, so we're looking here. They're going to spend less money during retirement. So I'm going to also add that I would consider this a very successful plan. They've got excess in their savings goals. They're certainly going to be able to live near their current means. So they're in good shape. So now let's talk a little bit about the impact of the rate of return. So let's say we do an evaluation, we look at their asset allocation. They're really not a 70% stock investor. They're really more like a 50% stock investor. So we need to reduce that rate of return assumption, and we're going to put that at 6.5%. What's the impact on their plan when we reduce their rate of return assumptions? Oops, my bad. Sorry, guys. I need to get back to the right scenario. So in scenario 4, we're going to adjust their return assumptions. We're going to take this from 8 to 6. What's the impact on their plan? Well, now they're back in the red again. So why is that important? Well, we don't want to build a plan with unrealistic expectations on their returns if that's not really how they're invested. So you can start to see as we layer this out and we build their plan, we can look at different assumptions. Maybe we find out that they do need to take on less risk, or they can afford to take on less risk. So maybe we look at this and say, you know, you said that you feel a little bit too aggressive. You feel a little exposed there. So what if we do go to a rate of return that is a little bit more palatable to you? So now we're going to go down to, let's say, instead of 8%, we're going to be at 7.25. So now we're almost break even there. You know, we need to save an extra $3,000. So this would be a way that you could use the tool to tell the client you're taking on more risk than what you need, because that's a common issue too. People come in and they're 80% stock, but when you really look at their goals, you start to say you don't really need to be that aggressive. You could actually be a lot more conservative and still get to where you want to get. So this tool helps us isolate risk tolerance as well. Okay, I'm going to go back to our scenario 1 and talk a little bit about insurance. So when we look at the insurance modules here, I'm going to go to our more detailed view. One of the things I love about the software too is we can change what columns the clients see. So I'm going to simplify this down for us so that we're really just going to focus in on the columns that are going to be the most important. So I don't need to see the year number. I just want to see the actual year. We're not really worried about legacy planning, so I'm going to take off desire to state at death. We do want to see how much they're going to spend and how much they're going to add, and we do want to see where they started. Debt reduction is really not a topic of their conversation, so we're going to remove that. So we don't need to worry about that, because when we look at their amortization table, they're going to be debt-free by the time they retire. So I love that we can customize based on what variables the clients care about and isolate those. So we're going to take off the home value, but we're going to leave the insurance piece. So now we've got, I'm going to back up the screen a little bit. Now we've got the variables and the spreadsheet that is the most appropriate for our conversation. And what we're honing in on is this lack of insurance. If you go back to the balance sheet, we recall they're underinsured. So Alan showed this a little bit, but one of the things that I think is really important, I'm just going to put my own little plug in here, is the difference between having a client focus in on term insurance versus variable universal life and the cost associated with that. I didn't share this, but a quick plug, we're a registered investment advisor. We don't collect commissions. So we are based our fees off assets under management. So we're always looking to be fiduciaries and keep clients' costs as low as possible. So what we want to do in this case is look at a client here and say, you're going to be much better off with term life insurance to cover those 20 years and take the $14,000 difference that you might be spending on variable universal life insurance. And why don't we add that into the portfolio, into a brokerage account, or make sure we're maxing out our 401ks, or do backdoor Roth contributions, or add to a brokerage account. So what I love about the tool, though, is that we're able to look at this and plug in and say, okay, if we need $4 million, what would the cost be over different types of products? And spike that conversation for clients, because a lot of times, unfortunately, clients get sold insurance policies that may not be appropriate for their needs. Okay. So great tool to have that conversation. I also think that, it's common that, for the CPAs to sit down and start to see things, and they start to uncover these annuities and variable universal policies. And this might be a way to help illustrate the difference in costs. The other one is investment expenses. So we use an annual investment cost of 0.75%. Personal opinion, I think investment costs should be a lot lower than that. And the erosion that you have on a portfolio, if we compare, we're going to duplicate scenario 1 again. So now scenario 1 and 5 are the same variables. So I'm going to just isolate those for you guys so we can see that what variables essentially are the same. We're going to demonstrate a lower cost investment strategy. Okay, so we've got all the same variables. We just duplicated that. They're a $3 million deficit. What if we change that investment expense to 1/4%? The difference in their amount needed has gone from 10.4 to 9.7. So there's $700,000 less money that they would need if they're able to reduce their investment costs. So, one of the things we've got as an appendix to the slideshow today is, things that CPAs often, overlook would be questioning some of those investment expenses that you may see on brokerage account statements, making sure that they're reasonable for your clients, and making sure that they're not being taken advantage of on a cost perspective. The other would be is, what if we look at this and say, what if we have a more tax efficient strategy? So now we've got nest 1 and nest 5 back equal to one another. What if we have a more tax efficient investment strategy? So in this case, maybe the client is going to use municipal bonds versus taxable, and they're going to start focusing in on 401k savings, or maybe they're going to open up a cash balance pension plan. They're going to do something that's just going to be more tax efficient. So we're reducing those costs. That's a $300,000 difference in the amount they need to save. And I know it might be difficult to see in a shared screen, but I'm looking at these two columns and showing that tax efficiency has a huge impact. So intentionally trying to get into the weeds a little bit. I think at the high level, we've talked about just kind of how do you prepare that baseline scenario, but also demonstrating that a tool that allows you to isolate different variables and show the impact there can be really important. Alan, as I pause there, we could probably go back to our slide deck, unless you have anything you'd like me to illustrate.
Well, would you mind just talking a little bit about what a client today would expect from Social Security on retirement?
Sure. Meaning just benefit-wise, or just kind of planning ideas?
Yeah, benefit-wise, what is a wealthy client going to get in Social Security benefits when they retire? And do you know what they're going to pay to be on the best Medicare plan?
On the Medicare plan, I'm not certain, and that's very state by state specific, and it also can be very client by client specific because of their needs. So I wouldn't have a good estimate there. On the Social Security piece, when you look at the calculation of Social Security, it is weighted towards the lower wage years versus the higher wage years, meaning that someone that makes $1 million and somebody that makes $50,000, the first $50,000 have a greater weighting into the calculation than, say, the last $50,000. So I would expect that most of the clients that we work with, if you look at their full retirement age, which is the year which Social Security gives them their kind of like actual benefit. You can take it earlier, you can take it late, and that adjusts it by about 8% a year. And I can be more specific on that, but about $3,000 a year would be a pretty common benefit for somebody that's been a high income earner and has a long work history. If you flip to, and I'm going to give back the presentation to Alan so he can do the slide deck. Alan, how would I do that?
Joey, how do we take back the presentation from this renegade planner?
So I just put it back to you, Alan.
Okay.
So you should be
Great.
good.
Show my screen. All right. Let's do the last poll. Go ahead.
I was going to say, after the polling question, if you go to the last slide, I've got some talking points for Social Security.
Oh, okay. Let's do those now, and then we'll.
Okay.
Polling question.
So Alan asked the question of generally what could you expect from Social Security? Most of our clients that would be retiring in the next couple of years, it'd be common for them to have a $3,000 benefit at age 66. That'd be very common, give or take a couple $100. Now, the question of when you draw Social Security will have an impact on your benefit. So if your full retirement age is, say, $3,000, for every year you file early, you're going to lose about 8% of that value between age 62 and 66. So somebody that's got a $3,000 benefit, is probably more in that 22 to 2300 if they were to take it at 62, and they're probably more like 3600 if they were to wait and take it, maybe closer to 4000 if they wait to take it at age 70. So when I hear the question of when should I start drawing my Social Security, you need to look at it on a spreadsheet and help illustrate to the client that a lot of it depends on your life expectancy. In fact, really all of it depends on your life expectancy. For most clients, when we look at the spreadsheets, around their early 80s, it doesn't really matter. Okay, whether you took it early or you waited, you get about the same total benefit. So the other would be is, what is that impact? There's tools out there that we have that we can help them understand what would they get at 62, 65, 67, 70 years old. Variables that are important to consider with their spouse. So for couples that have a large variance in their wage benefits during their lifetime, there is what's called the spousal benefit. So you're entitled to your benefit or 50% of your spouse's benefit. So if my benefit is $3,000 and my spouse's benefit is $1,000, my spousal benefit for my wife will be $1,500. Okay, she would get half of my benefit or her benefit. And there's things to consider there. You can't file a spousal benefit until the other folks have filed. So I have to file for my spouse to get the benefit. So I've found strategies in cases where it actually makes sense for a client to file early to allow for the spouse to file a spousal benefit. Things like, what if I die? Well, if you pass away, your spouse will then take over your benefit or keep theirs, whichever is higher. So if mine's $3,000 and my wife's is $1,500, if I were to pass away, she'll assume my $3,000 benefit. On taxation, for most of our higher earning folks, 85% of their benefits will be taxable. So if they had a $20,000 Social Security benefit, 85% of that will be taxable income. So about $17,000 will be taxable income, and the other $3,000 will be exempt. There's a difference between the spousal and the survivor benefit. So spousal is that 50% of your spouse's benefit versus survivor, which is what are they taking currently relative to your benefit. So that could be confusing. People sometimes mistake the difference between a spousal and a survivor. And then the one that we hear very often is people worry about future changes to Social Security, cuts in benefits. The calculator that I use has a built-in 25% reduction in the year 2032 to account for potential cuts in Social Security. That's not a political statement. That's actually, if you go to the Social Security website and you look at the information they share, they talk about that. So I do think it's important that clients prepare for changes in Social Security, and that may even alter the decision of when they file. So these were just some common ideas to talk a little bit about Social Security. We could spend 2 hours, and it would be fun to get into all these details. But these are some often common things that I hear from folks.
Okay, let's go polling question number 4. So far, with 9 minutes left, and we'll probably, and after, by the way, after we finish this in 9 or 10 minutes, I'll go through more of what the calculator does for anyone who's interested. But has this presentation impacted A, my own situation, B, how I will help others, C, this has been a complete life changer, or D, A and B, but not yet C? Anthony, what are the percentages?
A total, 25 for A, 13 B, 4 for C, and 58 for D.
Wow, 58% said D, and then about half the rest were mixed between A and B. And no one asked for a beta fish. All right, so back to the slides.
So the only other slide that I had was just an appendix related to some opportunities, just kind of revisiting opportunities for CPAs. Looking at our time, we could probably cover that in a few minutes and then turn it back over to you, Alan, to do kind of a wind up of Nest.
Perfect.
So that would be, I think, the slide before Social Security.
Okay, I thought I was showing it.
I see the polling still.
Yeah, Anthony, we have an issue there. What do we do, Joey?
Maybe try
closing your screen share, and then restarting it.
Where is my
So
screen
right,
share?
that green button on your control panel, yep. Try sharing there.
Did it come back up? Nope.
Here we go.
There it is.
Oh, okay. Good.
All
Take
right.
it away, Kevin.
Sure. So, these are common things that I think CPAs can look for. I mean, I can sit on the same side of that table as a CPA myself, but look to identify the lack of estate planning. And this is, I think, an important part of both the desk tool and the personal balance sheet. Is there a plan and is it implemented? And if there isn't, that's a very good value add to have with your clients. Addressing high cost investment products and advisory fees. Sometimes it can be difficult to disrupt an existing relationship, but as a fiduciary and as a trusted advisor, sometimes it's important to dig in and say, are you really getting what you're paying for here? And are these products even prudent for you? So that's an important part too, I think, of digging into the details. Initiate conversations with financial planners. I try to do that as best as I can to be involved with the attorneys and the CPAs. But I think it's an opportunity to further entrench your clients by saying, hey, can I reach out to your advisor and talk to them about your situation, see if there's anything we could be doing different, and try to engage in those conversations too. Helping get your client organized. It's so common that the balance sheet uncovers these lost little items. Clients have IBM stock that their grandparents gave them 40 years ago that either someday are just going to be forgotten about, or they're going to be an estate planning headache because the titlings are all wrong and it goes to probate and it could have just easily been transferred into a trust account or whatever those things are. But really helping clients get organized so they can stay focused is something that I think the CPAs can help out. Having those tough conversations about spending and savings. Many times the CPAs are the ones that see it the most. They're the ones that understand how well the business is doing, or they see the drains on the personal portfolios if the business isn't going well. Being able to step in and say, I really think you should meet with an advisor. I really think we should look at these some projections to make sure that you're doing the things that are important. For those folks that don't have advisory relationships, trying to get your clients engaged in a relationship with a fee-only advisor can help spurn a lot of these if you're not comfortable having those conversations. And then lastly, we talked about the insurance needs. How many clients do we have that own businesses that don't have key life insurance, or own businesses or don't have working spouses, all of those different things where life insurance can easily be overlooked. And again, focusing in on term insurance for probably 99% of your clients is going to be most appropriate if I generalize, because there's very few clients that are really going to benefit from the additional costs that come along with whole life policies or other permanent policies. So that's what I have for you guys. Turn it over to Alan.
But Kevin, a couple quick questions I see here. What range of inflation rates would you show if you showed client, reasonable, your best guess, and maybe what's a little worse or what's a little better?
Yeah, it's a great question. For my entire career, we were looking at 2.5% in almost every one of our projections based on kind of a historical perspective. I don't think we should abandon the historical perspective yet, because I do believe that inflation tames itself, whether we're able to do that through the tools that the Federal Reserve has, or if we have, or inflation tames itself because of just a broader global economic slowdown. But I don't think that we should look at unreasonable long-term inflationary rates like we saw over the past year. So to me, I don't think that advisors are doing the wrong thing by still looking at historical inflation rates, because I think that we will see a return to more normalcy there. But I think that it's prudent to look at two scenarios: one with something that's 2.5 to 3%, and then something that's 3 to 3.5, just to illustrate, if anything, the importance that inflation can have on eroding someone's wealth if they're not prepared for it.
Okay, very good. And then rates of return, it sounds like you can sort of nudge a client into a higher equities ratio by explaining that you can use a higher rate of return, and of course explaining the risk of inflation. But do you think 8% is a reasonable rate of return to illustrate, or what range would that be?
Yeah, so definitely going to be driven off a client's risk tolerance. So we need to understand their time horizon, their liquidity needs, and then their overall comfort with an equity portfolio. But I think that 7 to 8% rates of return for someone that was in that 45-year-old category, so somebody that should be able to accept risk in the 70 to 80% equity range, I think that that's still a very long-term reasonable assumption. 6.5% is a very good reasonable assumption for clients that are more in their balanced type portfolios, say 50% stock, 60% equity. There's one of the things though that's important, without getting too granular on the answer, is that not all portfolios are created equal. So if you've got somebody that's got a bunch of concentrated individual stocks, then that could really impact what their outcome is. Or somebody that's locked into some high cost variable annuities or something like that, that could really impact there. So it does take an analysis of their current holdings and a conversation about risk. But I think that this kind of 7% rate of return is something that we shouldn't abandon just because we've seen a lot of volatility in the markets.
Yeah, and just for you CPAs who don't give investment advice, I can't tell you how many clients have come to me and said the most important thing you've done for me, Alan, is make a strong nudge to a less expensive investment advisor, or you've shown me that these variable annuities that I bought were really a terrible investment and I didn't understand what they were, or helping me understand that term insurance was really all I needed because I'll be wealthy enough to not need a death benefit after age 60 that I don't want to pay for now. So if you're not giving, or just I ask the question, do you know how much your investments are costing? And they just give you a quizzical look and they go, well, here's my statement. Well, it doesn't show. Well, ask the investment advisor. Well, I did. They didn't really want to tell me. So this stuff goes on. So you have to decide as an advisor what your ethical and what your business approach is going to be in this area. But there's always going to be people like Kevin out there willing to help on an hourly basis or a fixed annual basis or a very small percentage of value basis, or Vanguard is out there and Fidelity's out there. And, there are choices besides high cost investment advisors. So Kevin, do you have anything else you want to say before I just give a little orientation to Estate View?
Nope. I just want to say thanks for the time, everyone.
Yep. Okay, so I'm going to go to home. I know you want to go home. You probably are home. My wife wants me to go home. But when you put in estateview.link and then test@test.com as your name, and then the word test as your password, the Nest calculator is on the bottom middle left. If you want to go straight to a life insurance estimator, that's the bottom left. You just click on that, put in the age, and it tells you what life insurance might cost. On the bottom middle, under the calculators, we have a very nice amortization calculator where instead of solving for the payment amount, if my client says, well, I'm going to loan $4,294,000 and I'm going to, let me see here, I'll solve for the principal amount. So, that I want to charge them 5.5%. I want to get 22.5 payments. Here's how much they can afford to pay me. What's the principal amount owed? And it solves for that. It's $4,600,000. So you can solve for anything you want there, and you can compare different calculators the same way that we compare savings plans. So that is the amortization calculator. On the far right-hand side, you have the news. So you click on the news, and you can pick 4 news sources here, like Bloomberg Wealth. I could pick New York Times Estate Planning. I can pick Forbes Money, and I can pick BBC News. So every 30 minutes, it's going to update me with the latest articles. So I can be seeing 4 news feeds at the same time. Then it would also show me summaries. If I want to see summaries, it can show me the authors if I want to see the authors. And it can show me up to 7. Now, eventually, there will be a chat column where there will be a lawyer or tax advisor being the moderator of the day for people to ask questions and engage in discussion. So that's that. Oops, I closed Estate View. Let me reopen it. All you do is you go to your browser and I put in estateview.link. It already knows me now, and it restores to all my settings. Another thing you can do is a married couple estate plan. So here you have John and Mary Sample. They have a $3 million investment house, 25 million of investments, a growth rate after taxes and insurances of about 5%. They're saving $1 million a year. So as of today, if they die in year today, there's not that much of an estate plan. They do have life insurance that's not in life insurance trusts. So the estate tax is 4.6 if they die today. If they die today with all of the strategies we have for them, there would be no estate tax. If they die with no planning in 20 days, the estate tax is 49 million. Now, let me adjust some of this to make it a little bit more believable. Most clients don't save $1 million a year. Let's have them save $325 a year until age 59, and then they'll save $75 a year. And most clients don't have 20 million. Let's give them 17 million. And most clients do not have an explosive asset, so I'll turn off explosive asset. So here they are with 17 million of investments, a $3 million house, and life insurance, as you see here, causing an estate tax with no planning of 16 million. Now, that assumes 20 years of growth. If they use a bypass trust on the first death, their estate tax goes to 15 million. If they use a qualified personal residence trust system, based upon the scenario we've chosen, their estate tax goes to 13 million, and they can see these trusts so they can help them understand them. If they do annual gifting, based on the scenario we have, then their estate tax goes down to 11 million. If they do discounted gifting using LLC interest, the estate tax goes down to 10 million. If they use life insurance trusts instead of life insurance, that's going to reduce what's going into the gifting trust because of the use of the crummy powers, but that's going to reduce their estate tax to 11 million. Then if they do an installment sale, it can reduce their estate tax to 4.5 million. And if they go with a testamentary charitable disposition, then that estate tax with all the other methods will bring them to a zero estate tax. They can either use a CLAT or a straight charity. So you know, I've covered a lot of stuff here in very little time, but you can choose any one or more of these strategies that you want to illustrate. You can easily change these variables that I have here. If you want to know how much life insurance might cost, you can click here for life insurance estimates. If you want to see the history of CPI, so you can try to decide what rate you want to show, you can do that. If your client has what we call an explosive asset, we often get clients who come in and say, well, I have a $3 million business, but I think I can sell it within 3 years for 15 million. I can just go to the exploding business module and put in the whatever scenario we think they should see or what they want to see. Then the personal residence and the Cupert inputs are here. Bypass trust, it'll tell me the maximum I can put into a bypass trust. Gifting, life insurance policy by policy, using term or permanent policies, and then an installment sale. So all I did in the installment sale was I had them put $7,050,000 into an LLC. Then they sold a 99% interest in the LLC for a $4,935,000 note. They made a $631,000 seed capital gift. And then they also put in their explosive asset. So the total sale was only $6.3 million, yet we're pulling a whole lot, $24 million out of their estate, which is why the installment sale works so well. So I can close these assumptions, go back, and now you know where we got these numbers. For example, the installment sale, which is very popular, so much savings. You can see how much ends up in the installment sale trust when you click on the installment sale, which I accidentally turned off the installment sale here. Let me go turn it back on. Installment sale. So before the installment sale, 27 million tax. After the installment sale, 13 million tax. I could also scroll up and down on some key things like what year they're going to die and investment returns. Another view is that I can look at a timeline. So this shows me the first death here and what the estate tax is on the second death for each of the years, depending upon what year they may die. Or, for example, if I click on without installment sale, you can see a lot more tax. With installment sale, a lot less tax. Or while I'm viewing this, I can just put more into the installment sale. So how much as I click more into the installment sale, you see it clicking the tax is reducing. So that can be done live while the client's watching. I can also move back that first death to see move back and forth each death right here while I'm watching to get to the view that I want to show. And I can, at this point, once I have the plan where I want it, I can do a short video. Just go to Zoom or go to my meeting, record a short video for the client explaining my inputs in each of these scenarios. And if the client is fairly sophisticated, I can click share with client or share with anyone. I can share it with the CPA. I create a 6-digit code, which is the code that they'll use to open it. And then I'll click create ULR, then copy to clipboard. So now I can send an email with this code here to the client by email, and then they can open up the software automatically with all of the settings exactly as you see here. So they don't have to re-enter the settings, and then they can play with the assumptions and come up with their own solutions or where they think they should be. I can also click generate client letter and pick whatever scenarios, and then I can click on generate client letter, and it takes about 45 seconds to a minute to generate the client letter. I'm not going to do that right now because I don't want to make you wait 45 seconds to a minute, but the sample letter is here that shows you what comes up. So, and then I can print that. For some reason, the sample letter didn't come up. Well, let's go ahead and generate client letter. So I click on this and I generate client letter. Now the letter's being prepared. The letter is done in just a few here. The modern computer. So then it shows me all the letter that I just opened is a Word letter. It shows all of the assumptions that I just put into this computer that you saw, including their name and my name. And then it explains the estate tax in general, and it shows each of the scenarios. Reopen here. Then what I could do if I wanted to is I could just change one thing only. For example, a big thing to change is whether the exemption is going to go to half in 2026. If it does or it doesn't, then I could rerun the letter and show them the results with or without the exemption, or I could show them the results with or without portability. So that is the main module. I have the same module for a single person. If I click on single person, then it's pretty much the same, but it's only for a single person. But for a single person, I can also set forth what their exemption is remaining and whether there's a credit shelter trust that was formed for their spouse. And then finally, we have calculators for qualified personal residence trust, charitable remainder trust, CLATs, GRATs, private annuities, life expectancy, et cetera, et cetera. So I hope you'll give it a spin to use it for free, to give us input so we can continue building this out. I'm going to close off the program here. Thanks again to Kevin for all of his help on this. Thanks to all of the attendees, especially those of you who stayed until the bitter end. I hope that you have a fantastic weekend and that you use some of this knowledge to help not only your family, but also clients and other advisors. Thank you very much.
Thank you, Alan. Thanks, everyone.
All right, take care.